Welcome back to this Capsim Foundation introduction. In the last video, we finished an overview of the marketing dashboard. We now turn our attention to the production and HR dashboard. For the purpose of this discussion, we will defer discussion of the HR section for a future video. This will allow us to focus on the production schedule. The window containing the production schedule is located in the upper left-hand portion of the screen. The first section consists of how many units, in thousands, of each product you plan on selling in the coming year. Remember that the values of most quantities and dollar amounts are in thousands of dollars. The unit sales forecast is the value you inputted on the marketing dashboard, or the benchmark forecast if no value was inputted. Below the unit sales forecast is the amount of inventory you had at the end of the previous year. Beneath the inventory is the number of units you plan on producing in the coming year. This value is underlain by the actual number of units that can be produced after adjustments, which may result from waste, supplier challenges, or other issues. Beneath the production schedule is a table discussing the margins for each product. If needed, you may choose to run 2 full shifts at your factory, and thereby produce up to 2 times the current production capacity of your assembly line for each product. The first line in this table describes the utilization rate of the second shift, which ranged from 0 to 100%. It is impossible for this value to expand beyond 100%. To produce more than the single shift of capacity, you need workers. Workers could be first shift employees that work overtime and therefore work a second shift, but alternatively, additional workers could be hired to work a second shift entirely. Second shift workers are paid a 50% shift differential. Overtime workers are also paid a premium, but they also get really tired and disgruntled quickly because they are overworked. The more stable the production level, the more second shift workers are hired and overtime goes down. Either way, the labor costs per employee will increase the higher the second shift utilization, but this may be a worthwhile expense due to the increased number of units that can be produced. Below the second shift utilization is the labor cost per unit. This is a function of not only the labor costs per worker, but the number of workers, which depends upon the amount of automation on each assembly line. The labor cost per unit is underlain by the material cost per unit, which is taken from the R&D section and is a function of the MTBF. The total cost per unit is the labor cost plus material costs. The bottom line of this section is the contribution margin, which is equal to the percentage of product price point from the marketing schedule that exceeds the total unit costs immediately above. We rapidly want to see this value exceed 30% to indicate a well-performing product. The bottom table of this window describes the physical plant. Each column here consists of the assembly line for each product, and the top line consists of the current first shift capacity of that assembly line. When we first begin, our assembly line has a first shift capacity of 800,000 units. This means that even with a full second shift, our factory can only produce up to 1.6 million units this first year. Beneath the first shift capacity describes the amount of increase or decreasing capacity you will make during the coming year. By entering 100 in this space, for example, you will expand your first shift capacity to 900,000 units next year. You could also sell some capacity by entering a negative number. This allows you to realize some salvage infrastructure costs, but this also limits the capacity further in future rounds. Incidentally, if you launch a new product, you will need to add capacity to construct a new assembly line. This is one of the challenges of developing a new product. You must invest in the assembly line in the current round, but cannot begin to sell that new product until later rounds. New product development is a longer-term play. Beneath the buy-sell capacity line is the automation rating. This describes the extent to which your assembly line uses machines. This value ranges from 1 to 10. The higher the automation rating, the fewer workers needed to run your assembly line, and the lower the labor cost per unit for that product. You can invest in increasing or decreasing automation for the next turn in the cell on the underlying line. The next line of the table consists of the total costs needed to fund the investments in capacity or automation. The max invest line describes the limit you have to invest in the current round. This is limited by your cash on hand and the decisions you could potentially make in the finance section. The final line of the table describes your AP or accounts payable lag. This is the number of days between receiving a vendor invoice and you paying it. The larger this value, the more uncooperative your vendors may become. They begin to withhold part orders in order to get you to pay quicker. This reduces the number of units you can produce in a year because you run out of parts. It's a good practice to pay your vendors quickly, but this must be balanced against the concern for cash flow if your customers pay you at a slower rate. Beneath the production schedule is a graph of production versus capacity for each product. This is essentially a visual representation of capacity and second shift utilization. To the right is a graph of how product price is broken down by costs. The blue component is the material cost per unit, the black component is labor cost per unit, and the green is the margin earned on each unit sold. This will help you to visually understand your profitability as you manage both material and labor costs per unit. Again, we will discuss the HR staffing portion of this dashboard at a later date. For now, we'll conclude discussion of production decisions and move to the last set of decisions pertaining to finance.